Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. Let us understand what is letter of credit. Let's look at this transaction. There is a seller and a buyer. Seller selling goods to buyer and buyer is making payment to seller immediately, and there is no complication in this transaction. We can say it's a normal transaction, but just think of a transaction where the buyer and seller are in different geographies or say in different countries, and they do not know much about each other. But this buyer wants to purchase goods on credit and seller is also ready to sell on credit, but seller does not know this buyer thoroughly, and because of that he lacks faith. And here the seller says to the buyer, if you can give me some kind of a comfort or security, I am ready to sell goods on credit. So what this buyer will do? He will approach his bank where he is having his working capital facilities, and he'll explain the situation that there is a seller who is ready to sell goods on credit, but he needs some kind of a comfort. So what this bank will do, after assessing the position of the buyer, that is bank's customer, this bank will send a letter called letter of credit, and in that letter bank will say, hey seller, you can sell goods on credit to this buyer who is our customer. And hereby saying this, bank is indirectly assuring the financial standing of the buyer, and then bank also gives assurance that buyer will make payment on the due date. And in case if the buyer is not making the payment on the due date, then do not worry, you come and ask us, we will pay you provided you guys have agreed on all the conditions. That is, you guys agree on conditions and comply with the conditions. Let's say for buying goods, buyer will place certain conditions, and only when seller comply with all the conditions, as a banker we will honor it. Okay, so that will be mentioned in the letter of credit by the buyer's bank to the seller's bank. Now seller has got a big comfort because there is an assurance, that too from the bank, that buyer will make payment on the due date, and even if buyer does not pay any money, okay, he is going to get that money from the bank provided that seller is complying with all the conditions that are mentioned in the letter of credit. Okay, so on the strength of this letter of credit, seller is going to sell goods to the buyer on credit basis, and it is the duty of the buyer to make payment on the due date to the seller. But what will happen if buyer does not pay on the due date? Simple, seller will ask the bank to make payment which has issued letter of credit, and this scenario will be called as devolvement of LC. If all conditions stipulated in the letter of credit are complied by the seller, then the bank which had issued LC has no room to escape. They have to make payment to the seller. Of course, eventually they can collect it from the buyer, but they got to meet the payment to the seller. So this mechanism is nothing but LC mechanism, and it promotes trade. It helps various transactions to take place. Okay, so this is about LC. And who are the parties generally involved in LC? Number 1, the buyer, we call him as applicant. 2, seller, we call him as beneficiary. And number 3 is the bank of the buyer, that is LC issuing bank. Okay, we call it as LC issuing bank. And the LC will not be dispatched simply through post. It will be routed through another bank in seller place. We call that bank as advising bank. And sometimes seller may be in a dominating position, or seller may not believe the LC issued by the issuing bank of the buyer. Seller may stipulate a condition saying that LC got to be confirmed by bank in his location. So another bank may also come into picture. We call that bank as a confirming bank, and it's through these banks the entire LC process revolves. Let's have a look at the types of letter of credit. Now, types of letter of credit would basically depend upon the method of payment, whether the LC is revocable or not, whether any middleman is involved or not, or whether any other transactions is involved or not. Okay, so it depends upon all this. Now, the basic classifications what we can have is number one, irrevocable LC. It does not mean we are going to have a revocable LC. That concept was removed way back in 2007. It means now all LCs that are opened are irrevocable in nature. It means you cannot, you can neither amend nor cancel the LC without the express agreement of all parties to the LC. So that's what we mean by irrevocable LC. It means when we say all parties, the applicant, issuing bank, beneficiary, all three minimum should agree. Then we can also have two or three other classifications or types of LC. One, we have site LC. Site LC is a case where the supplier is not giving, the seller is not giving any credit to the buyer. It means the buyer is opening LC in favor of seller just to get his confidence, so that he can send the goods, because the goods have to travel a longer distance, and the seller has a fear whether the buyer would pay or not, say without credit itself, because there is going to be a transit period and whether he will pay or not, so there is a fear. So seller has insisted on LC and buyer had opened LC in favor of seller, and that is a site LC. So in site LC, what is going to happen? The buyer's bank would open the LC, and by the time it reaches, that is by the time it is cited to the bank, the payment has to be made. Okay, it means if the seller is going to show the documents which are prescribed in letter of credit which is opened by the buyer in favor of the seller, and if the seller is going to show all the documents, say like invoice, say the transit documents, shipment documents, and insurance, whatever that is stipulated, and if everything is shown, then payment at site should happen. So here the payment is happening on or upon presentation of documents. Even though we say site, it would take minimum say 7 days, or it sometimes it goes like 7 plus 7 plus 7, 21 days. Okay, so that's about site LC. Then there is something known as use-on LC, where the seller is permitting a certain credit period to the buyer. So here the buyer would open the LC, it would reach the seller would showcase the documents, okay, and the payment for the seller would happen only after the use-on period plus these say that minimum grace period, or that 7 plus 7 plus 7 days. Okay, so credit period is offered by the seller, payment is going to happen on a prefixed date. Then we also have two other kind of LCs, inland LCs and foreign LCs. That's based on the geography. The LCs which are issued within the country we call as inland, and LC that are used in import-export transaction we call them as foreign LC. Let's move on to assessment of letter of credit limit. We know letter of credit is a facility which is given by the bank to enable its customer to buy goods on credit from his supplier. That is, bank will be issuing letter of credit in favor of supplier, so that supplier will sell goods on credit to bank's customer. So how this facility is assessed? It is purely linked with purchases. So first let's capture what will be annual purchases. Annual purchases, but not all purchases will be made on credit. There will be some cash payment, there will be some advance payment, there will be some purchases on credit without LC also. Okay, so we should know how much purchases are expected to be made under LC. So we'll say procurement under LC. There is going to be a certain amount. Say for example, if annual purchases is 120 crore, and let's say the procurement under LC is expected to be only around say like 40 crore. Okay, only 40 crore worth of goods are going to be procured under LC. Fine. Then we should know what is the monthly purchase. Monthly purchase of what? Monthly purchase of LC goods, okay, which is nothing but item number B divided by 12. So let me put that here. Item number B divided by 12, we get something like 3.33. Okay, so this is the monthly purchase of goods under LC. I'll rewrite monthly purchase of goods under LC. Fine. Now we should also factor the credit period, because this is on credit, right? LC is issued so that the customer can buy goods on credit. So what is the period involved in this? That is, we should capture total time involved here. Total time. Total time in the sense, two time factors are there. One is usance time period and the other one is lead time period. Usance time period is the credit period given by the supplier to the customer. Lead time period is the time taken by the supplier to execute the order. Let's say the bank's customer has placed order with supplier and supplier is going to take 21 days for executing that order. So that's the lead time period. And usance time period is the credit period which he gives. Let's say, for example, lead time period, that is, if a customer makes an order today, the supplier will take 15 days to manufacture those goods, and supplier is also giving 45 days credit. So if I order goods today, it will take 15 days for manufacturing, and from there 45 days count will start. So if I order today, payment will happen only on the 60th day. So we can say total time taken is 45 plus 15, 60 days. That is equivalent to 2 months, right? This is 60 days, which I'm going to say as 2 months. I'm going to say this as 2 months, right? So what is the monthly purchase of goods under LC? It is 3.33 crore. Okay, and I should give LC for 2 months requirement. So my monthly purchase is 3.33. Then for 2 months it will be 3.33 multiplied by 2. So I can say item E, eligible LC limit is nothing but item number C multiplied by D, which is 3.33 crore per month multiplied by 2 months. So this is the eligible LC limit, and this is how LC limits are assessed. Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far I have introduced 7 courses of 1999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, Collateral Securities, a comprehensive study. Course 9, How to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over, some more bonus. Course number 11, How to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.